What's up, Banter fam? I'm your host, Miles, and in today's show, I'm going to be discussing why GMX could be the best place to farm during this bear market, why holding GLP could provide better risk-adjusted returns than holding Bitcoin or even Ethereum directly, and how you can actually buy and stake GLP for maximal rewards during this bear market. Obviously, farming has become more difficult now that a lot of prices have decreased. A lot of emissions have now started to dry up. So we have to look for sustainable yield platforms or real yield platforms that are actually generating revenue to take advantage of these APRs. I believe GLP, which is the strategy I'll be showing you in today's video, is one of the least risky ways to actually earn 30% yield on your coins and actually earn more Ethereum while the market continues to go down. We know while prices continue to go down, if you are continuously farming and you're hedging that farming strategy, then you can effectively earn more Ethereum relatively risk-free. I'll talk through the risks, the benefits, the negatives, and exactly how to do it in today's show. Just before we get into my GLP staking strategy, remember that if you do want to sign up for a ByBIT account, we are offering a $4,200 sign-up bonus if you want to buy, sell, trade any crypto. If you are going to do this GLP strategy, you will need obviously either Ethereum or GLP tokens, which you can buy on ByBIT and then transfer to your MetaMask wallet to take part in this strategy. So yeah, link in the description, sign up for a ByBIT account, $4,200. You also get access to the Crypto Banter Discord, which is where Sheldon is posting his trades, and those trades will be relevant when he does the live trading shows. All right, let's actually get into this GLP strategy now. So the calculator guy did a tweet and he said, farm tokens with vesting schedules, interest-bearing wrappings, lockups, lure retail investors into being exit liquidity for sophisticated investors. This is the trend that we saw time and time again with farming tokens on the market that ended up resulting in a lot of these farming tokens going to zero or at least declining, extremely heavily in price, 99%, 99.5%, as a lot of these emissions essentially flooded the market with tokens, and the ones that got in early, the ones that got in with the ICOs, the VCs, they're the ones that ended up dumping on retail. And the reason this happened with many of these tokens is because there was simply A, not enough demand, two, too much supply, and three, it wasn't sustainable enough. There was no sustainable way to generate yield through these strategies because there was always a time limit on it. The time horizon, in some cases, was extremely short if you had steep cliffs to do with the emission schedules. But for the most part, most of these non-real yield projects ended up going to zero. So now the focus is really shifting for me personally, and I know for a lot of you as well. It's what projects and what yield farms can we actually deploy capital into, adopt a minimal risk, and two, expose ourselves to real yield or yield that is actually being generated from protocol revenue. One farm really, really stands out to me, and that is GLP. Thor said it feels like not long ago, 20 to 30% seemed like really low yield on most protocols. Now that same 20 to 30% on GLP is amazing and one of the best yield opportunities in DeFi currently. And I would agree with this sentiment. I think that the almost 30% you can earn on GLP is probably one of the best yield opportunities in DeFi currently. The difference, of course, lies in the quality of the yield. GMX provides earned protocol revenue paid out in ETH. For example, 99 out of 100 times it was token emissions to incentivize liquidity over a shorter time frame, which GLP doesn't do. So just quickly, how does GLP actually earn this revenue to pay this 30% out to holders? Well, it does so via trading fees. We can see if we look at the top 10 dashboard of average fees over the last 7 days, GMX comes in at number 4, doing $324,000 in a week worth of trading fees, $457,000 aggregated one-day fees. So GMX comes in on top of many other protocols. In fact, it's number 4, even ahead of Aave, Bitcoin, and other major networks for trading fees. So this is essentially how it generates this yield that it pays out to GLP stakers. Firstly, traders are incentivized to trade on GLP due to its low slippage and its 30x leverage. 2, people that want to trade on a DEX are incentivized to do so because you're not exposing yourself to a centralized exchange. So if you've got funds in a MetaMask, it makes a lot of sense to use a perpetual DEX to get those benefits, of actually trading on a DEX. So security, anonymity, low slippage, etc. And 4, GMX's model is especially helpful for market orders because on an order book exchange, if a large order is executed, the order is filled at the best possible price, which can eat up a large portion of the order book, whereas GMX does this in a slightly different way. It offers decentralized perp trading, so it allows you to get less slippage on your trades, which is one of the main attractors for people coming in and using the GMX platform itself. So if GMX can offer trade execution that's comparable to centralized exchanges, what has it done in volume? Well, it's generated over $56 billion in volume since its launch 1 year ago. We can look here and track the weekly volume on Arbitrum. Then in December, it launched on Avalanche as well, which is the red column of these lines here. And we can see that steadily over time, GMX weekly volume has been increasing. Now, we know that if the volume of the exchange increases, then inevitably the yield that stakers are earning for contributing to the liquidity pairs, they will also be increasing in their yield. So it's kind of got this two-pronged effect. More users equals more yield. Now, less users equals less yield as well. So it does go both ways. But as long as the assets that you're holding in the underlying basket, which I'll show you right now, are very secure and aren't exposing yourself to market risk, then at the end of the day, it's basically a cherry on top because it's free yield. So I'll explain how GLP actually works to make it simple for you guys so you can actually implement this into your own strategy. GLP is a basket of assets. So if we look through the assets under GLP, we could see it is comprised of Ethereum, Bitcoin, Chainlink, Uniswap, and a few stablecoins, 4 stablecoins here. These are all weighted in accordance with the LP or liquidity pool weightings. So if you invest in GLP or GLP tokens, you are essentially investing in all of these tokens that is on the list here. Buying GLP is not buying GMX. That is a separate token. That's the governance token of the ecosystem. Buying GLP is exposing yourself to this underlying basket of assets. Similar to what we saw on Beethoven, when you could create liquidity pairs with like 10 different tokens. This is doing the exact same thing, except you're getting exposure to these tokens. Now, these tokens are relatively risk off because these are primary tokens, a few of which are stable coins, which obviously don't deviate in price. The other few are very secure tokens that I think we all believe are going to be around in 5 years' time. Ethereum, Bitcoin, and Chainlink are 3 of the most secure projects with the most economic moats in crypto, arguably. So they've picked a pretty risk-off underlying basket of assets here that you could be fairly confident holding long-term and not losing too much in terms of capital based on the deviations from their original market price. Meaning, if you invest in GLP, since you're investing in these underlying assets, you're not exposing yourself to crazy swings in the market like potentially you would be if you invested in the GMX or the governance token directly. So how does GLP actually work? Well, it uses the liquidity pool here to bond trading between assets, meaning if you have multiple pairs balancing a pool, it facilitates swaps because it shortens the length of swaps between tokens. So if someone on the exchange wants to swap from Ethereum to Uniswap or USDC to Bitcoin or USDC to Ethereum, this actually facilitates that swap as the LP has liquidity, underlying liquidity, which is essentially incentivized by paying out this APR. So the difference between an order book exchange where you have orders on the buy side, orders on the sell side, like let's say a ByBIT would do, and it eventually matches up those buyers and sellers to sell to you at a market price or on a limit order. This does so by facilitating swaps through an LP. So it's not an order book. The swaps are facilitated by stakers staking this GLP token, which is this basket of assets, and then you can swap between them on the actual exchange. Now, this is why they are paying out a 28% yield to stakers, because A, they want to incentivize you to deposit so they have more liquidity to facilitate swaps, and B, you're getting an upside from the percentage revenue generated from the platform, because that is paid out to GLP stakers. That is their main incentivization mechanism for you to stake here. So if you buy GLP, and you can do so with Ethereum on the Arbitrum network, so you'll need to connect your wallet to the Arbitrum network. It's an EVM compatible L2, so you can just add it to your MetaMask. You can actually swap Ethereum tokens for GLP tokens and stake them under the Earn tab here. So if you buy GLP, which is, as I said, essentially like buying Ethereum, Bitcoin, Chainlink, and Uniswap and all these tokens, you can stake them under the Earn tab and earn yourself a 27% APR. Now, to me, this is a pretty enticing farm because you're earning 28% on a basket of assets, which I would consider fairly safe. And personally, I would be willing to hold GLP tokens for many, 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 many years. Obviously, the main risk here becomes smart contract risk. If GMX was hacked, based on all my research, based on the audits I've seen, GMX is a very secure platform. Of course, whenever it comes to MetaMasks and whenever it comes to decentralized protocols, there is that slight risk that exploits can happen. But at the end of the day, your main risk here is just smart contract risk, because these assets are likely to deviate and you're likely already holding Ethereum or Bitcoin. So it does make sense to have a significant percentage of your DeFi portfolio, in my opinion, staking GLP. Patrick said GLP staking on GMX is my new savings account. And this is how I'm viewing it. And I'm going to run you through the calculations that I've done here on Excel. So I'm viewing it as a savings account, because if I can earn a 27% yield, which is paid out in Ethereum, I essentially view this as earning more Ethereum tokens whilst absorbing minimal risk. This is really the beauty of this farm. You're not exposing yourself to a lot of risk. You're still capturing the upside from this decentralized exchange L2 narrative, but you are not exposing yourself to crazy price swings, given the underlying tokens are fairly not very volatile. So you can essentially view this as a savings account. And I've even seen people starting to take profits into GMX. So if you make 200% on a trade, I'm seeing people put in a percentage of that, let's say 20% of their profits, 80% goes into stables, the rest goes into GLP. And I don't think this is a bad strategy, because what this is enabling you to do is start earning an excess APR on your liquidity, which would usually just be stagnant if you're going to keep that in stable coins. Of course, it's not as safe as keeping it in stable coins, but you are exposing yourself to passive income. And there's a couple benefits from this. So the GLP token itself, the main positive is that it has less direct asset exposure and increased risk-adjusted yield. So you're earning yield on your tokens with a similar risk profile to if you're holding Bitcoin or Ethereum in your wallet anyway. The negative is that it has limited upside potential, and of course there's impermanent loss because the tokens are balancing against each other. If Ethereum 5x, you're not getting the full upside of the 5x because it's balancing between these tokens. This farm itself, though, is not really geared towards capital growth. If you're investing in this, you're not looking to make a 10 to 20x, which is why I think the impermanent loss argument is kind of irrelevant, because that really only comes into play when you're dealing with highly volatile tokens. No token in here, maybe apart from Uniswap, which is a very small weighting of the farm, I would consider to be extremely risk on. I think the rest are going to be relatively stagnant in price, which is a good thing, by the way, if your goal is less direct asset exposure and increased risk-adjusted yield. The GMX token itself, which is the underlying token of the exchange, the governance token for you to vote on GMX product upgrades, distributions, etc. This token is if you are bullish on GMX as a platform, where you would want to invest to capture maximal upside. This token has actually been ripping lately. It's performed very, very, very well off the back of the fee increase that I recently alluded to. And that's one of the reasons why GMX has been one of the best performers on the market. So if you wanted more upside and your goal was capital growth and you believe in this narrative and you're not after that 30% yield, you can capture the exchange growth value from investing in GMX directly. If you invest in GMX directly, you can stake that for 21.5%, and you do get some fee distributions as well. However, you have to note that this is a very, very different strategy from GLP. This is essentially, you need exposure to the underlying GMX token. Yes, you earn 21%, but it's a much riskier 21%, because that 21% is now all in one token or relies on one token, whereas GLP relies on this basket of assets, which can be considered, a lot safer. So that's the benefit. You get more upside, but the negative is that you are reliant on the revenue growth, and it's tied to the GMX value, which in recent times has been pumping. I actually am looking at adding GMX long-term to my portfolio. I'm actually not that interested in GMX directly at these prices, just because it's run a lot. It's pre-merge. The L2 narrative has been very hot, and I prefer to purchase this after a slight cooldown. So right now, my focus is more on GLP. And I think this serves the function of a savings account, potentially more effectively than holding Bitcoin or ETH directly. So you could make a strong argument here that holding GLP is the better risk-adjusted play than just holding Bitcoin or Ethereum directly in your wallet. Now, that might sound crazy to some of you at first, but let's actually break this down logically. You are holding a similar underlying basket of assets, so you still have exposure to Bitcoin and ETH. Yes, you have exposure to stable coins as well, but you are earning a 30% yield on top of those stable coins. So you're essentially earning passive income of holding GLP, essentially as a savings account. Now, a lot of other people use Bitcoin as a savings account. And if you invest in Bitcoin, you would then be angling for more than a 30% return per year in order to outweigh the risk-adjusted return of GLP. But you are hoping that that 30% is obviously on the capital growth of your Bitcoin holdings, because if it drops, then you're not earning 30% on it, because Bitcoin is not a staking platform, it's an investment. So the only way that it would technically outperform GLP is if it went up by more than 30% per year, which would rely on Bitcoin growing consistently over time. Now, a lot of us do believe this will be the case, by the way. I believe Bitcoin will probably average more than 30% annualized in, let's say, 5 to 10 years' time. But in the short term, if your goal is a savings account, because I know a lot of people save a percentage of their income into Bitcoin, you may want to consider GLP instead of a Bitcoin or Ethereum if that is the goal of your holdings, to essentially save or protect capital, because you are going to be earning passive income on your GLP tokens, which is pretty valuable considering the relatively safe risk profile of the underlying basket. Now, since this is true passive income, because it's not subsidized by token emissions and it's essentially real yield, you can actually take a percentage of these profits into the vault to stack yield. So if you're making profits on your Bitcoin or ETH, you may want to consider putting some of those profits into the GLP basket and earning that 30% yield on it. And you can earn more ETH without having full exposure to the underlying asset, because you are getting paid in Ethereum for staking. So you can earn more Ethereum. Of course, you can sell that off, buy whatever you want with it. You can keep it in ETH if your goal is to earn ETH. You can reinvest it into GLP if your goal is to earn GLP. But due to the relative risk profile, the risk-adjusted risk profile of the GLP basket, I really do like this platform a lot. And in fact, I'd go as far as to say it's probably my favorite yield farm in crypto right now, because 30% is a fairly good yield considering the risk profile here. And I'm going to show you in a second how to actually hedge that 30% to make it free, essentially. So the purpose of GMX itself would be to have a smaller percentage allocation. So if you do want to invest in GMX, the underlying exchange token, you'd want to probably have less than 5% of your portfolio allocated there. If you want exposure to upside, that is the case where you'd invest in GMX over GLP. Obviously, there's a few other alternatives here. There's GNS, DYDX, etc. Maybe you diversify into a few of them if you are trying to capture that decentralized perpetual exchange narrative. I would personally recommend the DCA approach, because I think the hype will eventually cool down, and you can hedge against upside with an initial entry. So if you don't have any GMX exposure and you want a GMX exposure, I never can hate on the strategy of getting an initial entry in, because essentially that's a hedge against upside, because we all feel FOMO in this market. Sometimes it's better. Let's say you have $10,000. Sometimes it's better to deploy 3,000 of that 10,000 up front, so you get an initial entry and you hedge against upside, so you can kind of squash that FOMO. So if you're in that position and you're dying to deploy capital, you actually could get an initial entry here, and then DCA, let's say, over the next 6 months if GMX is a narrative you want to play. Personally, I'm sticking with GLP, but I wanted to give the option there because I know a lot of you want to invest in GMX as well. So that's personally what I do. Obviously not financial advice here. There is a way, though, with GLP, which is the 30% that you get from this basket, to actually hedge all these assets to earn risk-free yield. Now, this sounds crazy, but it's based on the premise of delta neutral DeFi. And what delta neutral DeFi is it is offsetting your holdings with shorts in order to create a delta neutral scenario or environment, which means all your assets are balanced against each other. So if Bitcoin goes up a certain amount, you have shorts which will generate the equivalent amount of losses. And if Bitcoin goes down 20%, you have shorts which generate the equivalent amount of gains. So at the end of the day, what a delta neutral strategy would do is it would mean all your tokens are the exact same value irrespective of market conditions. So this means you are getting pure upside on the 30% yield. So if you did not believe or you weren't confident that this basket of assets would appreciate over time, I believe it will appreciate. So I'm not hedging delta neutral. But for those that are quite scared of this market, think there's further downside, but want to start earning yield, what you can actually do is buy GLP, invest it for that 30% APR, and then start hedging against this underlying basket of positions with shorts, the equivalent amount of shorts, to create a delta neutral scenario. So you're earning a 30% yield or a 27.6% yield clean, because the underlying basket at this point does not change. It operates like a stable coin. And then you are just exposing yourself to that 27% on your assets. That would be, in theory, a risk-free way of earning yield on your token. So delta neutral, just for those that don't know what it is, if I didn't make it clear, is a portfolio strategy which utilizes multiple positions with a balancing positive and negative deltas so that the overall delta of the assets in question totals zero. So if you have shorts offsetting longs, then essentially your delta value becomes zero of that underlying basket of assets. How can you delta hedge? Well, I'm going to flick you guys across to the calculator guy because he's the expert at this stuff. He shares his portfolio of how he delta hedges his holdings, earns yield on them, and hedges with puts. And essentially, he has a video called How to Delta Hedge on GLP, which I think is very good. Maybe I do this myself in the future. Essentially, what it consists of is entering on a spreadsheet the tokens that you're invested in, the percentage weighting they make up of the LP, how much you have invested. So let's say you invest $1,000. You want to weight that between all the 4 tokens in the LP. That's on the Avalanche side. On the Arbitrum side, it's actually 8 assets. You can stake on Avalanche as well, which is a different basket of assets. Slightly less yield. That's why I showed you Arbitrum today. But both work the exact same way. So it really just depends which basket you prefer. Maybe this one's a little simpler for those that want to delta hedge because it's there's less tokens and you don't have Uniswap and Chainlink. I personally like Uniswap and Chainlink because I want a little more upside. But if you want to follow this delta neutral strategy, then maybe you go for the Avalanche version, so you have less upside because you essentially just want the yield, right? Calculator guy does this, so he puts it into a spreadsheet and then he calculates the short value required. So you can do this using a rebalancing model to calculate how much short value you need to offset the amount that you have invested. So if you had $210 invested in Ethereum through the AVAX GLP pool, which is obviously assuming a total $1,000 worth of GLP bought, then you would need to hedge with $70 of Ethereum. So if you put $1,000 into GLP, since 21% of that $1,000 is Ethereum because the LP tokens are weighted, then the short value required to offset that would be $210. And he does this and updates you guys on his website and on his Twitter the exact numbers that you would need to delta hedge. There's also online calculators you can use to work out the short value required to delta hedge. Once again, it's not a strategy I'm personally doing because I am bullish. I'm bullish long term on the basket of assets. So I want my Bitcoin and Ethereum exposure. I think net it probably ends out higher than 30% if you include the capital growth from the LP tokens. But I know a lot of you want risk-free strategies, and that is definitely an option for you guys if you want to hedge against this underlying basket here. Get your 25 to 28% APR essentially clean. Of course, there are risks. It isn't a clean 27% because you got to factor in smart contract risk. You got to factor in trading fees with shorting. Obviously, you need to be rebalancing. So if one token skyrockets in the pool, then its weighting increases. So then the amount needed to hedge also needs to increase. So you need to constantly rebalance, let's say once a week on your tokens. Every time you rebalance, you pay trading fees, right? So you also have to factor in how much those trading fees equal and then minus it off the 27% APR. Maybe you pay like a 4% annualized fee for rebalancing, which would make your net APR closer to 23%. So those are all factors you have to consider. So it won't be a fully clean 27% yield, but that's for the people that want to take the delta neutral approach. Once again, I've said it 3 times already, but I am just investing in GLP, keeping it super simple, staking it, and I'm kind of treating it like my Bitcoin or Ethereum holdings here, taking some profits into GLP. I'm also if I'm buying more assets, so if I want to buy more Ethereum, I'm opting for a percentage of that Ethereum to go directly into GLP these days because I personally value the 30% returns relative to the potential upside of Ethereum, which is much, much greater than this liquidity pool. But I think that in this market, in these market conditions, the 28% is very, very good, considering you're exposing yourself to less risk. So every time I'm buying ETH or Bitcoin right now, I am, constantly thinking about what percentage I'm putting into GLP. I'd say that's probably around 20 to 30%. I've even seen people say, scrap Bitcoin, scrap ETH. I'm just investing in GLP because I don't see the point in holding Bitcoin ETH directly in these market conditions. That is a totally valid strategy. If you came to me and said you were not buying Bitcoin or ETH and you were just buying GLP, I honestly wouldn't laugh at you. I'd say, to be honest, in these market conditions, that's not a terrible move at all. I personally, though, am investing Bitcoin and ETH for the long term, so I want to capture upside there. So it doesn't make sense for me to just do GLP, but I know a lot of you have more bearish outlooks, and if that is you, then this makes a whole lot of sense in my opinion. So I hope you guys enjoyed this video. If you did enjoy, make sure you smash the like button and subscribe if you're not already subscribed. I am now actually going live on Instagram to answer your questions because you guys know I like to do a little bit of a Q&A, look through some live trades on my Instagram after each show. So if you want to hang out with me on Instagram, there's a link in the description. Come hang out. I also follow people that follow me back. And yeah, I'm really enjoying the Instagram streams because we're building a little community over on Insta, and it's a lot of fun hanging out with you guys after the stream. So yeah, if you want to hang out with me even more, ask me any questions. I'm live on Instagram right now. If not, I'll see you in tomorrow's show, 7:30 p.m. EST. Peace out, guys.